So far on this show, we have not looked at any mining companies whatsoever. So, today is the day. Hey there guys, welcome to the FTSE Show with me, Chris Chillingworth. Hope you are doing well. This is the show where we take apart FTSE companies, UK-based London Stock Exchange companies, and we are looking for companies that have the greatest odds of growing 300, 400% over the next 10, 20 years. That's specifically what we're looking for. If they have great dividend yields, that's a bonus, but we don't search that out. So we're looking for companies that are geared up, that have the performance, are doing the right things with their profits, have the right trends going on in their financials, that would suggest that these are companies that are going to grow 300-400% over the next 10-20 years. We are going to look at Polymetal International today, a mining company, first mining company of the show. They are pretty tasty in terms of their financials, so let's dive into those numbers and take a look. Okay, let's take a look at Polymetal International PLC then. Epic code is POLY. These guys are in the FTSE 100 and they're obviously in the mining sector. So, before I start, we've got a ton of construction work going on here right now. Lots of work going on at this location. You're going to hear probably diggers and cranes and all sorts of stuff. So if that bleeds through, then tough luck. So, with Polymetal International, we've got clear signs of growth every single year. As you can see here, we've gone from $500 million to 560 million to the 95 million in 2010, then 1.3 billion, 1.8, dropped down to 1.7, then 1.6, then 1.4. So from 2012 to 2015, we had consecutive years of fall in revenue, which would have been a bit of a concern, and that'll be interesting to see how that played out with the share price and whether that had any effect to that share price when we look at the chart in a moment. But certainly from 2012 down to 2015, we saw 4 consecutive years of fall in share price and quite considerable drops each year as well. And then since 2015, it's been a bit of a turnaround because we've seen the revenue coming in at 1.4 billion in 2015 to 2016's 1.5, then 1.8, then almost 1.9, and then in 2019 2.2 billion in revenue. So overall, long term, over the last 12 years, we've had a very strong revenue growth from this company, but obviously that 4-year period where we saw a drop off and then it's recovered and it's far exceeded where it was during the height of 2012. So we've moved past that point now. They've progressed further, which is great. So looking at the cost of sales, they've obviously grown along with the increase in revenue. Of course, we would expect that, but to what degree? Is it growing faster than revenue or slower than the revenue? Well, looking at the gross margin, we could pretty much say that is pretty standard all the way through those 12 years. It's been up and down. There have been peaks, there have been troughs along the way. But if we were to highlight this gross margin from 2008 to 2018 and get the average gross margin amount over that period of time, we'd be looking at 44%. Well, in 2019 it was 46.5%. So what that's telling me is that the gross margin or the cost of sales, it goes up, it goes down, it fluctuates over time. But generally speaking, over the last 12 years, this company have been operating at an average of 44% gross margin, which is fine. That's a very good level of operation. It means the cost of sales are growing at the same rate as the rise in revenue. What it also means is that gross profit gets to increase as a result of that, so that's great. So we've got a company that's making more and more profit every year. And we can see if we pick 2012, which was that peak year before the decline in revenue, they were making 998 million a year in gross profit. We saw that drop off considerably, but now as of 2019, since that kind of recovery from 2015 onwards, we're now at 1 billion revenue. 1 billion gross profit. So we're up to new highs there in terms of the actual profit amount, which is good. Looking at the expenses rate, again, we've got a similar picture here. We've got some kind of peaks where expenses seems to jump up very, very quickly for 1 year, then it comes back down the next year. And if we were again to highlight every year leading up to 2019, we'd have an average expenses rate of 23.6%. In 2019, we're down at 17.4%. Now, we have seen it that low before in the past. We saw it in 2010. As you can see, we saw it in 2016 as well, down at 16%. So it seems to be every now and again the expenses costs drop, and then they go back up again for a little while. But when they go back up again, they've never reached a point that would be a concern for me. As you can see, if you're watching this on the show, because some of this goes out on podcast, but you can see here the expenses, they're all green, every single year green. It's because I'm happy with the amount that they're paying expenses, even at their highest levels. We've got no issues in terms of interest on debt. That's about 8.6% of the operating profit. That's a good, healthy level. We probably find that when we look at the debt levels, they're not too bad. And then we come down to net earnings. Now, Polymetal International have done fantastic. If we look at these net earnings from 2008 to 2019, pretty much every year has been very, very good, apart from 1 year, which we'll pick up on in a minute. But as you can see, in 2008, 14.4%. That's pretty good already. That's pretty good. But as you can see, most years we're dancing around the 30% figure, 25 to 30% net earnings a year. That's a huge margin. That's a fantastic margin. I've gone through 400 companies. I've gone through every company in the FTSE 100, the 250, the small cap, the fledgling, and I'm currently going through the FTSE IM markets. Trust me, there are not many companies out there making 30% net earnings a year consistently. There really aren't. So this is fantastic numbers. Now in 2013, we saw them make a loss. They had a losing year in 2013, and it's very interesting to try and work out, well, why was that? And really what we can tell here is that obviously this was the start of the decline, but it certainly wasn't the lowest point in terms of the revenue. We'd only just started to see a decline in revenue at that point. It hadn't reached its lowest point, which was actually 2015, when it went down to 1.4 billion. So it wasn't necessarily, it was the start of the decline in revenue, but it wasn't. That doesn't tell you the whole picture. But what we can see here is that a stark increase, a jump in the cost of sales, and that had a massive effect. We went from 855 million in the cost of sales to 1.2 billion, then back down to under a billion. So it was a massive spike. And in fact, as you look in the future years, the company have never had cost of sales that high since. So in 2013, they paid 1.2 billion in cost of sales. Well, in 2019, they've just hit 1.2 billion, but we're still 60 million under that level. So yeah, there was a big spike that ate away all the profits of the company that year. And yeah, we also saw high depreciation costs all of a sudden, just 1 year, just massive depreciation costs came through at 213 million. And it just seems like the year where all these costs suddenly came through. Interest on debt expense rose that year as well. And so, yeah, it wasn't a good year for Polymetal International as a result that they lost 32 million, which pales in significance to the other years where, you know, the previous year they made nearly $500 million in profit. So losing 32 million 1 year wasn't the end of the world. But again, be interesting to see what effect that had on the share price, and having a look and see what happens there when we look at the chart in a moment. But other than that blip year, that 1 year where things did just look bad, when the costs obviously went too high, these guys have been consistently growing and consistently making fantastic returns. And let's just pick the last, the last 5 years prior to last year, the average net earnings was 25%. Last year, 2019, 29.1% net earnings. So they're on the up as well. And in the last 3 years, we've seen it grow from 22 to 25 to 29%. So that's fantastic. Things moving in the right direction for Polymetal, and a fantastic track record to go with that as well. So I'm liking this. This is very good. This is the sort of thing I'd like to see in a company that I want to invest in. Looking at the current ratio, 2.8, really healthy. So the current assets outweigh current liabilities by 2.8x. Nearly 3 times more assets than liabilities, short-term assets against short-term liabilities. Very, very healthy. Very, very healthy. Fantastic. Looking at the, I want to go down to the debt levels. I wasn't expecting this to be too bad, and it's not. Looking at the long-term debt, we're looking at 1.5 billion, which sounds like a hell of a lot of money, right? 1.5 billion of debt, but we've got to bear in mind that this we have to calculate this as what is it relative to the power of the business, the size of the company, and that we can look at the earnings of this company, and they're making 650 million a year in true net earnings. Okay, so when you carry in 1.5 billion, it's going to take you therefore about 2.3 years to pay that off based on current earnings, and that's absolutely fine for me. Totally cool with that. They're not biting off more than they can chew. They are borrowing at a level that is consistent with the size of the business and the power of their earnings. So more than happy with that, and they're obviously, this is why the interest on debt is looking relatively healthy as well. We can come down to retained earnings. Retained earnings are looking very healthy. They haven't always looked healthy. Again, back in sort of 2013, 2014, we've seen a significant drop-off in the retained earnings, but that has recovered over the last 5 years from minus 23 million to plus 780 million. And there is a consistent focus on pumping money into retained earnings. What that means is that they're not just paying everything out in dividends, they're retaining some of that profit, and they're probably doing so for some sort of opportunities that might come up in terms of acquisitions. There may be other reasons for it. They may be planning on buying back some of their own shares at some point in the future, which again is a positive thing if they do that. And the return on shareholder equity is at 30%, very, very strong again. So these are all really strong numbers. Very happy with the financials of this company, apart from that blip year in 2013. Let's go and take a look and see how the chart's done. Okay, so you have to forgive the drilling in the background. I have mentioned that before. It's all going on behind me. But we can see here we've actually got a float date on the exchange of, what month is this? This is October 2011. So the data that we've got there that we've been looking at from 2008 was pre-float, some of that. Which is interesting, but I'm particularly interested in this period here, the 2012, 2013, 2014. This was the period where the numbers started to decline, and what do we see in the share price here? We see a decline in share price. This is a monthly chart, so this is quite a substantial long-term decline from highs in terms of share price of 11, nearly £12 in January 2013. We saw that fall to, at times, September 2014. We saw a low then of £4.50. £3.15. So from highs of £12 to £3.15, we've seen that share price fall as those numbers started to go down. And then from 2016 onwards, we've started to see somewhat of a recovery. From 2016 to 2018, again, a bit of a decline there in share price, but really it started to take off at the bottom here at October 2018. And since then, we've just had fantastic numbers. Very interesting 2020 numbers. Look at this. We see so many companies that in 2020 massively plummeted in value due to the events of 2020 and the crash. Well, we see none of that here. There's nothing. No Polymetal in February, we saw a decline of 7%, but bear in mind when the overall market fell 30%, that's nothing. And you can see by March completely recovered and then some. 15% increase in March, and then in April an 18% increase. And these guys have done very, very well in terms of share price. And this is exactly what we're looking for, right? We're looking for companies that are ticking all the boxes. And what we tend to see is successful share price growth as a result of that. You know, there's the numbers and the parameters and the criteria that we look for in these companies. We don't just do it for the fun of it. We do it because it's directly correlated to share price growth. And when we see successful companies like this, we see successful share price charts as well. And so these guys are now trading at £16 a share. It's the highest they've ever been. Could this go higher? Well, if these results carry on, if this company continues to grow in the way that they've been growing, then absolutely this could continue. So yeah, very positive. Let's go and see how they did on the leaderboard. Okay, so Polymetal International. Couple of stats, couple of bits of information here that may change things for you, that may not. So First of all, price is about £16 a share right now. As of today, at time of recording, £16.13. They've got an earnings per share of £1 per share, which is actually a 6.2% return. If you were to buy all the outstanding shares at £16 a share, you'd be getting a 6.2% return on your investment. That's pretty good. That would indicate that the price right now is at a okay level. It's not overpriced like many of the stocks currently in the FTSE indexes. Looking at the assets of the company, this company has 1.9 billion in equity, or net assets, if you will, and 471 million shares outstanding, which gives them an equity per share rating of £4.03. That's 25% of the share price, which gives them a price to book value or ratio of 4. So all of this suggests to me that this is a good price for Polymetal. It's not amazing, but it is a price that I would be willing to buy at. Very, very, very good. Dividend is currently paying out at 3.1% per year, so that's pretty good. That's the kind of average for many of the stocks in my portfolio. We average about we've got companies in there that don't really pay much of a dividend, other companies that pay 1%, other companies that pay 5, 6, 7%, and so on average we see the kind of average dividend yield to be about 3% on my portfolio, and so Poly fit in just right with that. It's a typical kind of dividend return. It's not amazing for dividend investors. They would be looking for something more, but like I said at the beginning of the show, we're not really searching out based on the dividends. If they've got a high dividend, it's just a bonus. This is a company that look like they have all the hallmarks of a company that's probably going to grow in value over the next 10 or 20 years. I like them very much. All the numbers look fantastic, and the price isn't crazy. It's not a bad price. £16 seems a lot, but bearing in mind their earnings of £1 per share and the asset per share value of £4 a share, that's not bad. That's actually pretty good. So let's get them up on the board. Okay, so Polymetal International, EPIC code POLY. Very close. Polymetal score 126 points. They are the fourth company that we have looked at on this show so far this year that have scored over 100 points, and they absolutely deserve it. Those financials are very strong. The price is entirely separate, so the price isn't factored into this, right? The feasibility of whether or not the shares are affordable has no bearing on the score here. This score is purely based on the financials. What is the company doing with the financials? What's the company doing with the profits that they're making? How much profits are they making? What do the trends look like? Are things moving in the right direction or the wrong direction? All of that kind of stuff. All of it's factored into the algorithm. All of these companies are scored in exactly the same way against the same algorithm. And Polymetal have done a fantastic job. Their financials are very impressive. And let's get them up on the board. Okay, they're up on the board, second place. So fantastic score. And the first mining company we've looked at, and they've gone straight to second place, which is awesome. I think they're one of the best companies, one of the best mining companies out there in the sector. So they fully deserve that second place. The financials are very, very strong. We've lost Cineworld. Controversial. A lot of Cineworld fans in the comments, especially when we looked at them. But for me, their day has come and gone, unfortunately. So we've lost them off the board, and there's only 2 companies left with a minus number now. So any companies we look at that don't score above these numbers, they ain't going to make it onto the board. So it just shows as the program progresses, the caliber of it always improves. We've looked at 91 companies now on the FTSE AIM market, and as of September, we're going to be doing a separate show on just the FTSE AIM markets, which I'm really excited to do because there's some really interesting companies at that level. Much smaller companies, most of them, but really interesting to see how they're performing. There's some atrocious results in there, and there's some really good companies in there as well. So I've been very surprised at what I've found. I've obviously shared all this with my members and the people that follow my work closely. And if you're one of those people, you'll obviously know some of the companies that we're really looking into and starting to dive into now from the FTSE AIM market. But as of September, we're going to be doing a new show. that comes as part of the kind of the package, the Mondays, the Thursdays, and we're going to do a separate day that week on the FTSE AIM. So that's coming up soon as well. But yeah, Polymetal International, second place on the leaderboard. They've done very, very well. Absolutely deserved. And thank you very much for watching, guys. I'll see you on Thursday. Cheers.